Hey traders, this is Blake Morrow with Trader Summit. I have with me once again Katie Stockton, founder of Fairlead Strategies. How are you? Good to see
I'm
you.
great. Yeah, good to be back with you.
It's nice to have you back here. And I love having you here, especially ahead of a key event. Well, we have a couple key events this week, but namely the FOMC. So if you're viewing this video, you're probably viewing it just ahead of the Fed. And there's no better person I'd rather talk to see the technical market, see what you're seeing, see how you're viewing the markets technically. It is Monday for us, right? And just seeing what you're seeing ahead of these key events. So, how are you seeing the markets here, Katie?
Yeah, Blake, I mean, listen, it's obviously when we get into these key events, which I would add to the FOMC announcement, the mega cap earnings that are scheduled to hit the tape this week, it does create the potential for added volatility. That's only natural. And it comes at a time that the market has seen a pretty decent relief rally or oversold bounce. So the major indices are pretty well off of their June lows. It's certainly off their May lows. And that leaves us in a position where we come into this week's reports and the FOMC announcement, we come into this with an overbought condition. It's a short-term overbought condition, not a long-term one, of course, but it is within the context of a downtrend, broadly speaking. So that downtrend really sets the tone, in our opinion, and we want to be respectful of it until we see indications of not a short-term low, but a long-term low. And we don't really have those yet. So we're somewhat cautious coming into these events this week. And we feel that with short-term overbought conditions somewhat widespread, that it creates some risk because, they have more potential to disappoint in a way.
It's interesting, Katie, if you think about where we're at today versus where we were at, let's just say maybe a year and a half, 2 years ago, and everybody was thinking that the Fed might pivot and become more hawkish. It's the exact opposite now, right? And back then we were hitting all-time highs, going into 2021, and every time the Fed was supposed to pivot and turn more hawkish, they never did. They just stayed dovish, and the markets continue to rally to all-time highs. And here we are in a nice bear market, and we are once again faced with the same question: is the Fed going to pivot? But people are hoping that the Fed might pivot more dovish, but it's to be seen, and so I'm really interested to see, broadly speaking, where you're seeing the S&P right now, because a lot of people are wondering, do we see the 200-day moving average, or do we see, maybe new lows again? And then seeing some of those broad or some of the larger cap stocks that you were talking about. Let's go ahead and take a look at your charts and see how you view the markets.
Sounds good, Blake. So, I mean, the levels are definitely important, but we're giving a little bit more weight to our indicators than the levels.
Okay.
This is a daily chart. Hopefully you can see this basically
Yep.
year to date of the S&P 500. And you can see the series of lower highs and lower lows. We have a lot of our preferred indicators on here. Probably the most important one to focus on right now is this, which is the stochastic oscillator. And it shows the overbought condition that the market is in as we come into these potential sort of volatility creators, if you will. At the same time, speaking of volatility, we unfortunately have a pretty oversold reading in the VIX. The VIX is inversely correlated, as you know, to the S&P 500. So when you have this oversold reading in the VIX, it does create the potential for increased volatility, especially when there's some news around the markets. And then we've seen historically the VIX does tend to find some support not far from its 200-day, which is this purple line here. So we are looking for volatility to pick up, and it's largely based on exactly what we're anticipating from the mega caps, which if you take Apple as one example, Apple being the biggest constituent of the S&P 500, it is overbought, as you'd imagine, after its relief rally. You can see that overbought reading here. It's a prolonged overbought reading. When we see those stochastics turn down below 80%, we take issue with that. That's essentially a short-term sell signal. And importantly, you need to look at this action within the context of what's happened on the long-term charts. If you look at this monthly chart of Apple, you'll see in the bottom window there, it's a monthly MACD still expanding on the downside. It means that long-term downside momentum is still an issue for the market. The same setup is carried over to the NASDAQ 100, to the S&P 500. So while we are viewing this as a cyclical bear move within a secular bull, you can see that in the monthly cloud model here, the shaded line that's rising. We do think that it will take some more time and probably price declines to get to a major low. So when we're thinking about the levels, we're really taking them within the context of how those indicators all line up. If we were to see a Fibonacci retracement level of roughly 38.15 based on the S&P 500 taken out, well, the next real important Fibonacci retracement level would be roughly 3,200. So if we take this important trough at the COVID low in 2020, and we take it to the peak at the start of this year, that's where we're getting our Fibonacci retracement levels. You can see 38.15 here at the 38.2% retracement, and you can see 31.95 here as the 61.8%. We would not rule out this kind of 31.95 area as a targeted level for the bear market cycle, but we really aren't ultra predictive in our work. We rather just like to keep those indicators on our side, of which they still are not from a long-term perspective.
So I wanted to ask you, since some of the there's a lot of technicians, myself included, looking at the S&P over the course of the last few months, seeing a head and shoulder pattern. How much validity, or any validity, do you put into chart patterns themselves? I know you look a lot at indicators, but how about like flag patterns, head and shoulder patterns, and the like?
Yeah, I mean, listen, if you can see one, great. I think most of the price patterns that we use in technical analysis are really derivations of support and resistance levels, right? You can't have a head and shoulders without having made a lower high and then a breakdown below support. So I certainly see what folks are talking about. Here's your left shoulder, here's the head, and here's the right shoulder, and here's your breakdown. Notice also the breakdown occurred below the cloud. So in a way, they're just really complementary. We don't spend a lot of time looking for the price patterns, but when we see them, we definitely perk up and let that inform our biases. And flag patterns, of which we're seeing really more to the downside, bearish flags, than to the upside, those certainly are high probability formations. We also at times will look at triangle formations. We had just recently looked at Tesla. It had this sort of coiled up formation and it broke out to the upside on a short-term basis. So we definitely give some weight to these price patterns.
Well, it's great that you bring that up, just because there are so many traders, technical analysis, there's so many different ways to view it. And you have basically a lot of different tools that people will be focusing on. And it's great to see that you do respect some of the price patterns that you might see in the markets. It's also, I want to point out that you had mentioned the VIX, and I think that's a really key development that has been that is happening, because in early June, volatility wasn't breaking out and the stock market continued to hit new lows. And I think that was a really good leading indicator that suggested that we'd get this oversold bounce, which has obviously occurred, that we're witnessing right now. But it's also equally important that you're pointing out that volatility is being oversold, and it is near some pretty critical support as well.
That's right. So we look at them sort of hand in hand, because one can inform the other. And, I don't think anybody would argue that there is potential for more volatility during earnings season, just from a bottom-up perspective. We have had a very top-down oriented market. So earnings season actually creates opportunities on both sides of the market for those folks who are informed whether earnings are favorable or unfavorable, or likely to be that way. So it does create opportunity. That opportunity, we think, is probably more on the downside after the bounce that we've seen. And so we'd be really respectful of any breakouts or breakdowns that do unfold on the back of earnings reports, especially if they're in the direction of the prevailing trend for that stock in question. So it creates an opportunity for more, or less correlation, which is sort of welcome, I think, by a lot of the folks that we talk to. Correlations have been very high from a bottom-up perspective. So at least there's that, but we do think it's more likely to the downside.
That's okay. Well, thank you very much for that. Speaking of correlations and something that's been really the predominant driver of the markets as of late, we've had this massive rally in the dollar index as of late, and we've seen it pull back. We're at a 38% Fibonacci retracement right now. But how do you see the dollar currently? Do we have further upside, or is the dollar really putting in a more major top, would you say?
We don't have indications of a major top for the dollar index as of yet. This is a weekly bar chart, and you'll see
Yeah.
that all the moving averages are pointing higher. They're still diverging. Even this weekly MACD indicator is still positive. So we have no major sell signals, if you will, not from the DeMark indicators, not from the MACDs. So we want to be respectful of the uptrend and assume that it will keep hold on a very long-term basis. You can see on this monthly chart, the dollar index broke out above some former highs or peaks on the chart, and that was a major long-term breakout. So there's a little resistance just above 109 for the dollar that it's probably pulling back in part because of that level. But the next real major level is closer to 121. So you can see that there's really sort of a clear path for the dollar to continue to forge higher.
Wow, that would definitely wreak havoc on a lot of different markets, I would say. Before I let you go, I want to talk just about cryptocurrencies because you and I have had plenty of discussions about Bitcoin. I remember before it hit a new all-time high, you're like, it's going to hit another all-time high. It did. We came off quite aggressively, and Bitcoin came back to that big 2017 breakout point, 2017, 2018 breakout point near the 20,000 mark. Price action's been kind of bearish here with Bitcoin. A lot of people are calling bottoms and that we're going to hold. But how do you see Bitcoin or some of the crypto space, if you will, because we've seen so many come off. It looks a lot like the .com bubble back in the late or early 2000s. How are you seeing things right now?
Well, these cycles have unfolded much more quickly than we would normally anticipate, but it's a newer industry, newer asset class, if you will. So, I think volatility is really the only guarantee from these cryptocurrencies at this time until we get widespread adoption on the technology front, on the regulatory front, and then, of course, in kind with the markets. So with that, we expect more volatility, and we've been more bearish of late, just given the turnaround that we've seen. You can see Bitcoin peaked here in November of last year. We've also seen, the equity market weak over that time frame as well. And so it's really all risk assets have been penalized, but Bitcoin more than average because it is riskier. So it's just a higher beta type of way to get that exposure. So the downtrend again here, we're assuming that it has its hold still. We've seen some reaction to an oversold reading around that level you cited, which is drawn back to the 2017 peak, roughly 19,500. We'd even widen that out to about 18,300, which is a Fibonacci retracement level. So that's the zone of support that we've been watching for some time. We think that we'll see this relief rally ultimately fail and for the downtrend to resume, which would then increase risk to the secondary support level, which is based on the 2019 high. So same kind of methodology behind that support level. 13,850 is the approximate level. And that's where we, I guess, in part hope, but also suspect that we'll see more of a major low established. And we say that because of the monthly chart, which is really just newly oversold. It's not often that we get these oversold readings on a very long-term basis, and they usually take a few months to resolve higher. So we're in no rush to make a call that Bitcoin is done going down. We really want to see more out of it. And this goes for equities as well in the way of a basing phase, so a process as opposed to some kind of V bottom. We think that's what's going to be required of the markets this time around, and really has been the case mostly during these types of bear market cycles. So we're watching for a basing phase. We think it will probably come from lower levels. Near term, just like equities, there is a short-term overbought reading that's now creating some reaction. We'll see if that gives way to a breakdown, but let's suffice it to say that it is still in this bear market cycle.
Well, that's it's good to hear you say that. I'm sure some crypto traders and investors may not so be excited to hear what you had to say, but the bounce has been fairly shallow considering the sell-off that we've seen. So it's going to be interesting to see if we can really get a foothold below that 18,000 level, as you were just pointing out.
Right.
Katie, what I'm really excited about is I want to hear a little bit about your ETF and how it's doing. How's everything going over there at Fairlead Strategies?
I mean, it's been great in terms of the ETF, which is the ticker is TACK or TACK, and it's called the Fairlead Tactical Sector ETF. It has a design to take advantage of sector momentum and relative strength when the sectors are exhibiting that, of which we really haven't had a completely risk on tape, as you know. And because of that, TACK also has an asset allocation ability to it. So it has moved largely risk off because it doesn't have enough of these sectors meeting the qualifiers. It is a systematic strategy based on technical analysis. And right now it's only exposed to energy and utilities on the sector front. And it's gotten sort of increasingly risk off as time has passed since its inception in March. And it has fairly large positions that are nearly equal weight between gold or GLD, and then short-term treasuries and long-term treasuries also via ETFs. So that exposure has helped it really outperform and minimize the drawdown in such a difficult market for the S&P 500. Last I looked, it was outperforming by about 10%. That changes day to day, just depending on how volatile the S&P 500 is. But we're happy with its ability to limit drawdowns in this kind of environment.
I was going to say, how many investors are really looking to do that and to reduce drawdowns right now? So TACT, is that correct?
TACK.
TACK, TACK. Got it. You know what, Katie, that's awesome. I'm glad to hear that everything's going well over there at Fairlead Strategies and with your new ETF. And I want to thank you for spending your time with us today ahead of the FOMC. I know it's a key event this week, and I know a lot of people are going to be clinging on to the information you gave them today. So thanks for spending your time with the community here at Trader Summit.
Of course. Happy to, Blake. Take care.
You too. Bye-bye.
Bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.